Hey, welcome back everyone. My name is David, and this is Sleek Capital. And today, we are diving into something that a lot of investors are searching for right now, especially with all the uncertainty in the market, the non-stop AI hype, and the constant fear around the economy. Because in this video, I'm bringing you 10 incredible dividend stocks that I believe could quietly build massive wealth over the next decade, while also paying you consistent income along the way. And this is not just another random list filled with overhyped names. These are companies with real businesses, real cash flow, strong competitive advantages, and in many cases, stocks that have been absolutely crushed over the past few years, creating what I think are some very rare long-term opportunities for patient investors. So whether you're looking for a huge rebound potential, growing passive income, or simply safer stocks to hold during volatile markets, this list has something for everybody. So smash that like button, subscribe for more investing content every single week, and let's jump straight into stock number 1. Kicking off this list, I want to start with a company that I believe is one of the strongest long-term infrastructure plays on earth, and that is NextEra Energy, ticker symbol NE. Now this is not just another boring utility company. NextEra is actually one of the largest renewable energy producers in the entire world, with massive operations across wind, solar, battery storage, and traditional utilities through Florida, power and light. And what makes this company so interesting to me right now is that the stock has been heavily beaten down due to high interest rates, despite the business itself continuing to grow. At one point, the stock had dropped nearly 40% from its highs, which is very unusual for a company with this level of quality and consistency. But while Wall Street has been focused on short-term fears, NextEra has quietly continued expanding its renewable empire, while America keeps pushing further toward electrification and energy independence. And the crazy part is that electricity demand is expected to explode over the next decade because of AI data centers, electric vehicles, and advanced manufacturing. All of those things require enormous amounts of power. So when I look at NextEra, I see a company sitting directly at the center of one of the largest infrastructure trends of the next 20 years. Meanwhile, investors today can collect a dividend yield near multi-year highs while waiting for that growth story to continue playing out long-term. Moving into stock number 2, we have a company that I think has become one of the most overlooked dividend growth stories in the entire healthcare sector, and that is Johnson & Johnson, ticker symbol JNJ. Now most people know Johnson & Johnson for things like Band-Aids, Tylenol, and baby products, but the reality is that this is one of the most diversified healthcare giants on the planet, with massive operations in pharmaceuticals, medical devices, and advanced treatments. And despite being one of the strongest companies in the healthcare industry, the stock has basically gone nowhere for years because investors have been worried about lawsuits and slowing growth. But sometimes those fears create opportunities. See, while the market has been distracted by short-term headlines, J&J has continued generating enormous amounts of free cash flow while increasing its dividend year after year. In fact, this company has raised its dividend for over 6 straight decades, which is one of the longest streaks in the entire market. That level of consistency is incredibly rare. Plus, healthcare demand is only going to increase as populations age globally. By 2030, millions more people will require surgeries, medications, and advanced treatments, all areas where Johnson & Johnson already dominates. So when I look at the stock, today trading well below its historical valuation averages, while offering a very attractive dividend yield, I honestly think this could end up being one of those stocks investors regret ignoring once sentiment eventually turns around. Now for stock number 3, I want to talk about a company that practically owns a piece of the digital economy itself, and that is Digital Realty Trust, ticker symbol DLR. And if you don't know this company, they are one of the largest data center REITs in the world. Essentially, they own the buildings and Infrastructure, where enormous amounts of internet data are stored and processed. So every time you stream a movie, use cloud computing, interact with AI models, or even browse social media, there's a good chance that data is flowing through infrastructure connected to digital realty in some way. And as AI continues exploding globally, data center demand is rising at an unbelievable pace. These facilities are becoming just as important as power plants or highways because modern economies literally cannot function without them. Yet despite that massive long-term trend, the stock got hammered due to rising interest rates and broader REIT weakness. At one point, shares fell close to 50% from their highs, which pushed the dividend yield much higher than normal. But the business itself remains incredibly important and continues signing long-term contracts with major enterprise customers around the world. So to me, this feels like one of the clearest pick and shovel plays on the future of AI and cloud computing, while also collecting strong passive income at the same time. Up next at stock number 4, we have a company that I think could quietly become one of the biggest comeback stories in consumer staples, and that is PepsiCo, ticker symbol PEP. Now, most people immediately think about soda when they hear Pepsi, but this business is far bigger than just soft drinks. PepsiCo owns an enormous portfolio of globally dominant snack and beverage brands including Gatorade, Doritos, Lay's, Mountain Dew, Cheetos, Quaker, and many more. These are products people continue buying regardless of what the economy is doing. And yet, despite that stability, the stock has recently been under pressure due to slowing consumer spending and concerns around inflation impacting margins. But historically, companies like PepsiCo have always found ways to adapt through pricing power and global scale. In fact, this company has one of the strongest distribution networks in the world, allowing it to dominate shelf space in grocery stores almost everywhere. And from an income perspective, Pepsi is incredibly attractive because it has raised its dividend for more than 50 consecutive years. That's dividend king territory. So when you combine recession-resistant products, global brand dominance, long-term pricing power, and a growing dividend stream, I think PepsiCo looks very attractive while sentiment remains weak. Now at stock number 5, I want to shift toward financials with a company that I believe is one of the safest long-term banking plays in America, and that is JPMorgan Chase, ticker symbol JPM. During times of economic uncertainty, weaker banks often struggle, while the strongest institutions become even more powerful. And that's exactly what we've been seeing happen over the past few years. JPMorgan is not just another bank. It's arguably the most important financial institution in the United States, with massive operations in consumer banking, investment banking, wealth management, and credit services. Every time there's volatility in the economy, businesses and consumers tend to move towards stability, which benefits giants like JPMorgan enormously. And despite all the fear around recessions and interest rates, this company continues generating staggering profits year after year. Plus, they've consistently returned enormous amounts of cash back to shareholders through dividends and buybacks. What also makes this stock attractive to me is that banking is still one of the few industries where scale truly matters. Smaller competitors simply cannot replicate the infrastructure, customer base, and regulatory advantages that JPMorgan already has. So while the market constantly worries about economic slowdowns, I think JPMorgan is positioned to emerge even stronger over the next decade. Coming in at stock number 6, we have one of my favorite boring but beautiful businesses in the entire market, and that is Waste Management, ticker symbol WM. And yes, I know waste collection doesn't sound exciting at all, but honestly, that's exactly why I like it, because no matter what happens with the economy, people still produce trash, businesses still need waste removal, cities still require landfill management, and very few companies have the infrastructure and permits necessary to compete at scale. Waste management basically operates inside a giant moat protected by regulations, logistics networks, and high barriers to entry. It's incredibly difficult for new competitors to replicate what they've built over decades. Meanwhile, the company has been expanding into recycling, renewable natural gas, and sustainability initiatives, creating additional growth opportunities beyond traditional garbage collection. And because this business generates such stable cash flow, they've been able to steadily raise their dividend for years. The stock itself rarely looks cheap because investors recognize the quality of the business, but during broader market pullbacks, opportunities occasionally appear. And long term, I think this remains one of the safest compounders investors can own. Now for stock number 7. I want to talk about a company that has quietly become a giant in the world of semiconductors and communications infrastructure, and that is Broadcom, ticker symbol AVGO. This company has become absolutely critical to the modern technology ecosystem. Their chips and software solutions are used across networking, cloud computing, smartphones, AI systems, and enterprise infrastructure. And while most investors focus on flashy AI names, Broadcom has been one of the biggest winners behind the scenes. But what separates Broadcom from any other tech companies is the combination of growth and shareholder returns. See, this company has been aggressively increasing its dividend for years, while also generating massive free cash flow. In fact, Broadcom's dividend growth over the past decade has been extraordinary, and despite already becoming a massive company, the AI boom could create another major runway for growth because advanced networking hardware is becoming increasingly important as AI workloads expand globally. Meanwhile, the company's acquisition strategy has helped diversify revenue streams far beyond semiconductors alone. So when I look at Broadcom, one sees a company benefiting from some of the biggest technological trends in the world, while also rewarding investors with a rapidly growing dividend stream. All right, moving right along to stock number 8. We have a REIT that I think remains one of the strongest long-term income plays in the market, and that is Realty Income, ticker symbol O. This company is often called the monthly dividend company because they literally pay shareholders every single month instead of quarterly, and over time, that consistent income stream can become very powerful for long-term investors. Now, Realty Income owns thousands of commercial properties leased out to businesses like Walgreens, Dollar General, convenience stores, grocery chains, and many other recession-resistant tenants. What makes this business so attractive is the structure of their leases. Most of them are long-term triple net leases, meaning tenants cover many of the operational expenses themselves. That creates highly predictable cash flow for Realty Income. But because REITs have struggled during the high interest rate environment, the stock has been pushed down significantly from previous highs, driving the dividend yield much higher than normal. And historically, whenever quality REITs trade at elevated yields due to macro fears, patient investors who buy during those periods often end up doing very well long term. Meanwhile, Realty Income continues expanding internationally and acquiring additional properties, steadily growing its real estate empire year after year. Now at stock number 9, I want to talk about a company that I think could be one of the most important infrastructure plays of the next generation, and that is Caterpillar, ticker symbol CAT. Most people know Caterpillar for their giant construction equipment, bulldozers, and heavy machinery, but what many investors underestimate is just how deeply connected this company is to global economic development. Think about it, whether it's roads, energy infrastructure, mining operations, factories, AI data centers, or massive government projects, all of it requires heavy equipment. And right now, countries all around the world are pushing huge infrastructure investments while simultaneously reshoring, manufacturing and upgrading power grids. That creates enormous long-term demand for companies like Caterpillar. Yet despite this strength, the stock still periodically gets hit by recession fears because investors worrying about cyclical slowdowns. But historically, Caterpillar has proven extremely resilient across economic cycles while continuing to reward shareholders through dividends and buybacks. Plus, advancements in automation, energy systems, and industrial technology could create additional growth opportunities going forward. So for investors looking for a combination of industrial strength, infrastructure exposure, and rising shareholder returns, I think Caterpillar deserves serious attention. And finally, at stock number 10, I'm going with a company that I believe is one of the strongest long-term consumer brands ever created, and that is Coca-Cola, ticker symbol CO. Now yes, I know this is not some flashy high-growth AR stock, but sometimes the best investments are the companies that quietly dominate global markets decade after decade. Coca-Cola products are sold in more than 200 countries worldwide, and the company owns one of the most powerful distribution systems ever built. Their brand recognition is practically unmatched. Even in remote parts of the world, people recognize that iconic red logo instantly, and despite concerns around health trends and changing consumer behavior, Coca-Cola has continuously adapted by expanding into water, sports drinks, coffee, energy drinks, and healthier beverage options. Plus, during economic downturns, people still buy affordable comforts, which makes beverage companies surprisingly resilient. And from an income perspective, Coca-Cola is legendary. This company has increased its dividend for more than 60 straight years, which is one of the most impressive records in the market. So when I look at Coca-Cola today, I don't necessarily see a stock that's going to triple overnight. What I see is a business built for durability, consistency, and long-term wealth creation over generations. But there you have it, everyone. 10 dividend stocks that I believe could offer a very powerful combination of income, stability, and long-term upside as we move further into 2026 and beyond. Some of these companies are deeply beaten down value plays. Others are infrastructure giants positioned for massive future trends like AI, electrification, and global aging populations. And a few are simply dominant businesses that continue printing cash year after year regardless of what the economy is doing. But that's exactly what I look for when building a long-term dividend portfolio. I want companies with strong competitive advantages, durable cash flow, growing shareholder returns, and businesses that I believe will still matter 10 or even 20 years from now. Now, of course, every investment carries risk, and you should always do your own research before buying anything. But personally, these are the types of stocks that I think could quietly build serious wealth over time, while also helping investors sleep a little easier during market volatility. So let me know down below which of these stocks is your favorite and which dividend stocks you think deserve a spot on the list as well. I always enjoy reading your ideas because some of my best future research actually comes directly from this community. And as always, thank you all so much for watching. Don't forget to hit that like button. Subscribe to Sleek Capital for more investing videos every single week, and turn on notifications so you never miss a future upload. I truly appreciate every single one of you for spending your time here with me today. Take care, keep investing for the long term, and I'll see you all in the next video.